All right. Well, welcome to our Monday evening uh, meetup. We meet on the fourth Monday of every month at 7. We're going to be talking about what passive investors should know about underwriting. We just finished our networking component of our meeting, which is typically the first 15 minutes. And I always like to do that in the beginning because networking isn't something you can record or go back on. Like this is all going to be recorded, and you're going to get a recording of this um, meetup at the end. So, but the relationships and just talking to others, and what we find is like, especially people that are new to investing, um, coming to a place like this and seeing like, hey, everybody starts in one spot, and then over a year or two or more, people are doing a lot of things. There are several people on this call that started with us a few years ago and have invested in multiple deals since. So a little bit about myself. I'm based in Central Texas. We have about 60 million assets under management that we're majority primarily the primary lead sponsor. And when you think of lead sponsor, it's more like the jockey and the horse. We're responsible for the full uh, business plan. So from sourcing the deal to uh, executing on the business plan. For about 16 years, I was with a Fortune 150 company, CBRE, where I led about 4.5 million square feet of office uh, and retail industrial properties. And so I was doing the math today. So 18 years of my life has been in commercial real estate. And this is what I'm passionate about. I don't really know much different other than commercial real estate. So I'm excited to share some knowledge about it today and hopefully provide some education for you. One of my team members is on as well. Her name is Shelby. She runs our investor relations for CREI Partners. So if you're interested in getting to know us at CREI, I'm definitely going to be available and talk, but you'll also definitely get to know Shelby. She has been one of the greatest, I would say, investments of our company because building that hospitality and that experience for our investors is key because I'm definitely much more hands-on the operations and acquisitions and the development piece. But she's focusing on maintaining those relationships and building a great experience around the investment process. So some of y'all had mentioned that this is like your first time or first time in this meetup, but also in real estate investing. And so what I found was there are several people that have done month after month of our monthly meetup and invested over a year or two after getting a lot of the education from this call. So what I did is I created a passive investor coaching program. It's free. I don't make my money off education. We make it on real estate investing, but there's several hours. I think there's over 5 hours of content broken in short videos of how to look at a sponsor, how to look at a deal. A lot of the things that we're going to be covering today, I cover in that investor coaching program. So if you are wanting to accelerate your passive investor process, definitely go to passiveinvestorcoaching.com. There's nothing going to be sold to you at the end of it. It's just pure knowledge and education for you as a passive investor. So with that, I'm going to go into some underwriting. So for those that are on this call live, feel free to ask any questions. Shelby, if you see somebody ask a question in the chat or Q&A, if you can just interrupt me too, I'll be happy to answer questions. So I'm going to try to make this as easy and painless as process. For those that may be listening in later after this recording and maybe through a podcast or such, I am sharing an Excel spreadsheet that we are going to be going over. So the first thing I want to discuss is when we're looking at a deal to purchase, the first thing that we're getting typically from the broker or direct from the seller is the rent roll. And I'll pause there on the rent roll. So the rent roll is going to show the tenant names. It's going to show occupancy, the vacancy, what the current rents are. Maybe it'll have what market rents are. It'll have what additional income is being billed to a particular resident. Maybe there's pet fee. Maybe there's an amenity fee, utilities. So for every resident, and I'm speaking for multifamily, in the office, it would be a tenant. So, but for every resident, there's going to be their rent charge and what their monthly rent charges, plus any additional income and utilities. So there's miscellaneous income, and then there's utility income. So based on that rent roll, we're able to see, what the current occupancy is. At CREI, we wouldn't buy anything less than 85% occupied. We're not investors who want to go buy a very distressed deal and have to lease it up and take on that risk. Now, there's a lot of sponsors who are willing to take on that risk, and in return, there should be quite a bit of a reward. For us, we're like middle of the road, like to sleep at night type investors, and so we typically want to see a property that's 85% or more. So that's where we start, is the rent roll. Then what we will want to get from the seller is called a T12, and it's a trailing 12 months. And what that trailing 12 months, for those that are business owners or business minded, think of it like an income statement. You have your revenue all itemized, right? So you're going to have your base rent, you're going to have storage income, miscellaneous income, et cetera, for income. And then you're going to have your expenses. And all those expenses is trash, utilities, management fee, repairs and maintenance, insurance, taxes. So all those expenses, line items, we're gonna see that on the T12. And so if you think about revenue minus expenses is net operating income. So I'm gonna pause right there because I see some questions, and then I'll go a little further. You should be seeing. I'm not showing a rent roll right now. I'm just showing. You should see an Excel spreadsheet. Y'all see an Excel spreadsheet? I just before I go in.
No, I'm seeing return summary,
Yep. That's
project.
perfect. Mhm.
Oh,
Yeah,
that's what you
that's
wanted us to see? Okay.
yes. Yeah. So
All
for right
right.
now, because those documents I'm talking about from a rent roll and a T12, that's like step one, and then it all integrates into here. Um, so as we get the income and expense and the rent roll, that's sort of the starting point for us, and then we take it to our underwriting. So
Is
let me
this
go to
like
that.
a is this like an actual example, Wayne? Like I'm trying
Yeah,
to understand the context.
yeah. So what I'm trying to do is show you behind the curtain. Like if you're investing in one of our deals or another sponsor's deal, uh, they're doing some type of underwriting. The spreadsheet that I'm showing may be different than the spreadsheet they use, but it's sort of behind the curtain. Many times, what a passive investor will see is a presentation, a PowerPoint presentation about all the returns and all the great things about the property, but they're not really seeing the behind the scenes underwriting. And so, my hope at the end of this is I'll show you sort of what happens behind the scenes, and then what are some inputs that a partner, what a lead sponsor may be putting that is either potentially aggressive or not aggressive, if that works for y'all. And again, I'm happy to answer questions along the way as we go along.
Okay.
So
Yeah, makes sense. Makes sense. So what should we be looking for typically what I've seen is presentations, as you said, PowerPoint presentations, so you can't do much with it. It's a PDF
yep,
that we get. So what should we be looking for? What are like the
yeah,
inputs
yep,
that should be go through some due diligence or confirmation?
yep, yep. And I'm gonna go through all that in the next 30 minutes. So all that
Okay.
you're gonna have a very in-depth overview, but it's gonna be pretty high level. But I'm gonna try to get through as much of that as possible. But from a sponsor standpoint, you may not see this, but behind the scenes, a rent roll has been given to the sponsor and a trailing T12. So within that, they have their own underwriting spreadsheet. This is ours. So you're seeing CREI Partner spreadsheet. And what we're doing is we will put their income. So this will be like their T12. It's annualized, not on a monthly, but we'll annualize it. And then we'll put in our year one, our projections. So, and so what we typically will see is, if I go back to the assumptions, is on the underwriting, there's typically an asking price, right? It's called a whisper price. And in
Mm-hmm.
negotiations, there are, the seller's going to want X. The broker's probably telling them, you're not going to get X, but you're probably going to get Y. And we're going to find whatever that aspiration, or that's actually, so the aspiration price is the whisper price, right? And then what we're trying to do is actually find a strike price. So in this case, this is not a particular deal. This is I just made this up, right? This spreadsheet, but we can go along through this. So there's an asking price, say at 13 million two, purchase price I'm putting at 12,800,000. Now, what you would typically see, and this is going to be in the PowerPoint, that there's going to be a presentation of business plan that's given to investors. There's going to be fees that are associated. There's acquisition fees. There's going to be loan fees. There's going to be closing costs. There's going to be CapEx renovation and additional reserves. So these are going to be those fees and those expenses that are going to be on that PowerPoint presentation. All of this, say if I buy a property for 12.8 million, well, once you're done with all the capex and fees, et cetera, really the total basis is 14.2 in this example, 14.2 million. And then the total equity we'd have to raise is 5.2 million because there's going to be debt. So you ask the question of like, what are things to look for? One, they should be very transparent on the underwriting. They should send you the spreadsheet, and we do. So
Mm-hmm.
if one of our
Mm-hmm.
investors says, "Hey, send us the underwriting," like this spreadsheet should be sent to you. And a lot of times you've got some sponsors who are like don't want to share their underwriting. To me, that's a red flag. Why aren't they being just fully transparent and being like, "Hey, this is my underwriting." In underwriting, there's always going to be there's never a true like black and white. Like it's always going to be a gray area, and there's always going to be assumptions. So if I go into my annual pro forma and I start building out, say, the expenses, well, we know that property management fee is going to be about 3%, right? So if typically on a smaller property, say it's 100 or 70 to 100 units, this may be 4%. But because we have scale with this particular management company, we're able to get away with 3%. So those are things you could look at: management fee, G&A, and multifamily. There's usually a rule of thumb on price per unit, and since you're not having to actively do the underwriting yourself, the biggest thing is like look at maybe if you're looking at what the current seller is paying, right? And what the operator thinks that they're going to be doing, then you should be asking those questions. For example, like if I'm looking at this and I see on the seller's T12, which is on my underwriting here, 31,000 is what they spent over the last 12 months. But I'm underwriting, the sponsor's underwriting 150 a unit, 19,200. A question maybe asked is why are you budgeting 19,200 versus 31,000? And for us, this and there should be an explanation. So it could easily be like this management. There's not a professionally managed company. It's somebody who owns the asset. They're managing it themselves. They've got higher expenses because they're not sharing it across a portfolio. Whatever that is, it's just some of these things you could be, looking at and just thinking like, hey, does this make sense? For example, like income. And again, I made this spreadsheet up, right? Let's say year one, my effective gross income that I'm projecting in this hypothetical situation is 1,707,000. Well, the T12, so what the seller has been getting over the last 12 months is 1,480,000 in this example. So that's a huge income difference. So if I was a passive investor looking at this underwriting, I would be high level. In business, we're high level and then dig down. So look at income, total gross income, where the seller had it, where the sponsor has it, and then go to total expenses and sort of see, if they make sense. So does that make sense from that standpoint? It's like you're looking at the underwriting and you're saying, okay, this sponsor is making assumptions, and your job as a passive investor is to, make sure that they're being conservative or at least able to back up what they're projecting.
Makes
Because
sense. Makes sense.
once you sign that paperwork, and it's not scary. Like once you sign that sponsorship, syndication agreement, a PPM, subscription agreement, company agreement, once those are signed and you wire, the good news is you're fully passive, you're limited. But all this work up front is through education and then looking at the deal to see if it makes sense. And if you treat every deal as a business and not think of it overcomplicated, it's straight up business. It's a revenue, expenses, profit. And so if the revenue line items make sense, or at least can be explained, because maybe, this management company, they really were awful. Like they had a lot of management transition, they looked at the Google reviews and there's a lot of hate towards management. Maybe you can get this income up with good management, but you'll want to look at that and just see if it makes sense for you. But a lot of these expenses are going to be pretty fixed, right? Especially for somebody who's already been doing a lot of the work in that area. So like property management fee, We know where our G&A comes in. Contract service, it's already pretty close. So I just budget a little higher, but typically 350 a unit. Contract services typically 150. Marketing, or excuse me, payroll 1450. That's usually a rule of thumb for this, guys, is one person for every 50 units. So if you've got 100 units, you have one person in, one person out, meaning one maintenance, one person in the leasing office. And so that could be a question to ask: is, what are you thinking on personnel and on-site management? If it's 130 units, so it's not exactly the 150. Typically, we would do one in, one out still. But at 150 units, you're going to want at least two people in, one person out, or three people. So repair and maintenance, 250. We do budget a little lower on R&M because we have CapEx dollars. But that's how that's how we would do it. Now you could, when you talk to a operator and their, whatever their R&M shows, you can ask those questions. Typically there's a property condition assessment report, and that property condition assessment report is done, typically required by the lender, to have a third party professional company do it. And so that could be something you ask for. It's like, let me, ask for the property condition assessment report. Over time, a lot of our investors we have at CREI Partners, they trust they start trusting, and they're like, hey, we've had several deals. And so they don't really ask as much. But in the beginning, with any relationship, you want to trust but verify. And so those are things to look for. Insurance, if you're investing in Houston, this number is going to be a little higher, maybe 1,300 a door. But in San Antonio, you can get 800 and 900 a door. Real estate taxes, typically 100%. So this is one thing to look for, is ask about, taxes. Like, is taxes 100%? And I'll give you an example. So all these numbers, right, it all translates into internal rate of return, equity multiple, total average. So on our underwriting, we do 100% of purchase price. But what if I just did some groups out there only do 85% of purchase price? So just that one change, again, my underwriting shows 100%. So I sleep at night knowing that no matter what happens in an appraisal board, I'm not going to pay taxes higher than what I purchased the property for. But if I made it 85% of purchase price, that IR jumped from 15% to 18%. Equity multiple is 2.17. And so for insurance and taxes, think of those two, especially in Texas, as the biggest drivers of expenses. That's what the bulk of the money is, going towards insurance and taxes. So insurance, just ask the sponsor or the person, have you worked with an insurance broker? Have you gotten a quote? They better say yes. And you can ask for it. I mean, that should be transparent. There's nothing to hide on insurance. And then on real estate taxes, I would say they need to be doing 100% of purchase price in the first year, right? And so I'm going to just change that back. So that would be something to look at as well. And then typically you'll see an asset management fee, 2%, go from there. So these are some other metrics, and this is going to be recorded. So if you're doing notes or such, you'll get this, and you can, look at it as well afterwards. But there's some metrics that we like to look at, and one of them being the debt service coverage ratio. And so typically a lender to do an agency debt or a non-bridge debt, they typically want to see a 1.25x. So what that means is for every $1 of debt service paid, there's 25 cents left over to pay other expenses. So if you're at 0.8 DSCR, what that means is you're not even able to pay the debt service. So you need to make sure you got lots of reserves, because you're not hitting debt service. And maybe that's a deep value add and there's a business plan behind it. At a 1x, you're just paying debt and not operating. So you better have reserves. In this case, we're at, in this example, we're at 1.46. So this is something to ask, is what is year one DSCR? What I saw in 22 to 2024, DSCRs were less than the debt. It was like 0.8, and lenders were doing it. And there was a business plan probably of doing bridge debt, doing major renovations, increasing rents. And then when things didn't go their way, rents didn't go up, and um, you know, business plan didn't work, then there's still negative cash flow, and then they're struggling. So that's something to look at. I did get a question here. Uh, so what happens if you have an expense that shows up older than the T12? So if there's an expense from the prior year, so that's a really good question. So I don't ever, I don't ever really look at a broker's opinion of value from a sense of their expenses. And I also don't really care what the seller's expenses are, because I know I'm going to operate it the way we're going to operate it, right? It's a good checks and balance, but we know how we can manage, and how, based on due diligence. Now, when we do due diligence, we've got our plumbing, electrical, roofing. We're walking every single unit. We're looking at foundations. We're looking at the environmental. We're doing all the inspections, including running cameras through plumbing lines. So we have a pretty good idea of like R&M. Payroll's pretty fixed. Marketing, we've got our typical budget, per door. And so if there's an outliner, like typically like insurance or taxes, sometimes there's in Texas, we're protesting real estate taxes every single year. So, maybe the bill was 250,000, but then there's like a $20,000 credit, and so for somebody who's not sophisticated, they may budget lower taxes because they're like, oh, they actually just paid this. Well, reality is that was a protest rebate. So did that answer your question? There will be some, if something was really high, like one of the, in this example, like repairs and maintenance. I mean, they spent 400 a door, and so it seems high. But but as a sponsor, if I'm digging in on their financials, maybe they're not capitalizing certain repairs. So they're putting make readies into R&M. So that makes sense. So I'm like, okay, well, I have my money separate in a capital account, still have R&M money, but we're just classifying it a little differently. If expenses are below budget, what happens? So if I'm budgeting, if this is what I'm budgeting, and our actual expenses become less, then just like in any business, the net cash flow increases. So say instead of 1450, I was able to get somebody for 1250, or 160,000. I was able to get somebody on the inside and outside for 160,000 versus 185,000. Well, that increased my net cash flow significantly. That net cash flow this year is what's paid out to you as the investor. So so when we look at our deals, we'll do our underwriting, and then the management company will do their own underwriting. They never see our underwriting. We always have them do theirs, and then we hold them accountable for their underwriting. That makes sense. So in some cases, like our numbers are less. Like we feel like we won't achieve the income that the management company is thinking, but we don't tell them like, oh, ours is less, you should change theirs. Just like, no, we'll keep our underwriting alone, keep it alone, or leave it alone, and you as the management company, will be working to hit that target. So did that answer that question? Again, on the expenses for the seller, you don't know if they're hiding things or not including things, or maybe they do in-house management and they're commingling. You just never know. And so we just base it on our expenses, and we also review with the property management.
So Wayne, I think my question is a little different. So
Okay.
there's a management company, and the management company is going to do their own budget, and we can hold them accountable to that.
Mm-hmm.
But if it comes lower, for example, marketing, right? I'll give you a simple example of marketing. So
Sure.
if if 75% of the units are occupied, and I don't know what the renewal rate is,
Mhm.
but let's say 75%, argument's sake, 75% renew, right? So your cost of advertisement is going to be very low because you're not spending any money on 75% of the units. You're
Right.
only spending money on 25% of the units. So therefore there's a significant difference in the cost. So how does that translate, right? Because the management company, or I guess the question is, does the management company keep that as their profit, or does it flow
Oh,
to the deal?
really great question. So the property management fee this year, this 3%, it could be 3.5,
Hmm.
it could be 4, it could be whatever is in the deal. That deal is based off gross revenue income. So whatever that gross revenue income is, that is their fee, and that's their only fee. Meaning, and then there's typically payroll reimbursements, which is this line item. So if they come
Hmm.
in less than budget, which is what we want, we're very NOI driven, right? Because the maximum, if we increase income, reduce expenses, we're maximizing NOI. Or if we're keeping income the same and reducing expenses, we're maximizing NOI. Or if we're keeping expenses the same, maximizing. So at the end of the day, NOI, as long as that's increasing, that this amount flows to you as the investor. So we want to be below budget. But what I tell our team members is sometimes, because we have in-house asset management, and when I'm looking and I get daily KPI reports about collections and our financials and all that stuff. So every day I'm getting a high level view of our KPIs. What I'm really focusing on is NOI because maybe leasing is being a little slow right now, but if we're able to manage expenses, we're still hitting our target from an NOI standpoint. So did that answer your question? They do not profit. The investor benefits from
Okay.
below budget expenses.
Okay, so if the cost is lower than expected, the investors benefit, and in the same regard, if the cost is higher than expected, then obviously investors are covering those costs, right?
That's right. Yeah. The so
Okay,
if this so if expenses were higher in a category, then on our because we do weekly
yeah,
asset
makes
management
sense.
calls. Yeah. So we're trying to drive the hardest part of a deal, and this is where you want to really understand the operator's experience and their history, is how can they land the plane safely? Ultimately, have they had a crash? Have they even
Hmm.
flown a plane before? And so, because if they are at the end of the day, if I if I'm landing the plane properly, I'm getting as close to this NOI, this projection, or higher as
Hmm.
possible.
Yeah.
And there's going to be one-offs. I mean, there could be an insurance claim. There could be something. I mean, there's those things, but um, ultimately, we are targeting our budget. And this pro forma is different again from our management company pro forma. So there's always going to be two different performance.
Got it.
But
One question about insurance. So
mhm,
when you have this as a management company, when you have hundreds of units under management, could you be self-insured? Do you have to
no.
use a third-party insurance company?
Well, it's a good question. I say no, but so typically, we typically do agency debt or with Fannie or Freddie, or we will do our debt through like a debt fund, and they will require uh, general liability and property insurance, uh, and that really protects them and their investors. So these debt lenders, they have their own investors, and so they're going to want to see that insurance. Now, if the seller and this is there's all different ways to skin a cat on in real estate investing. I, as a buyer, could be buying a property 100% cash, and then at that point, I can self insure. I have a property that we manage for one of our investors. It's our only property we manage that we don't own, but he's invested a lot with us, and we're happy to do it for him. He owns the property outright, and he self insures, and that's totally fine. But typically, when you have debt behind a deal, they are going to want you to have insurance for that particular asset and that entity, and covering the lender for any insurance that comes up.
Hmm. Okay. Okay.
Yep.
Yeah.
And, and,
Yes.
and, and then you can also do self. I have one deal in Houston that I did self, or excuse me, they did seller financing. So I still had to have insurance, and that protects them. But it, their insurance requirements are not going to be as robust as Fannie or Freddie on their insurance requirements.
Mhm. Okay.
One of the questions was, why do you not tell the management you're underwriting? Because it's a great question. A couple things. One, when I'm initially underwriting, a lot of these are how we operate a property based on our experience. But the management company, if they do their own management company and they're not clouded by our returns, then in a way, it's a check and balance. Because and this is just a hypothetical underwriting, as I mentioned, but if I can hit 877,000 NOI year one, 893 year two, then I'm able to hit these returns above. Now, what if the management company came in at 900,000, 920, 950, and that typically happens. The NOI typically is higher than what I projected. That's fantastic. I'm not going to tell them that my number is less and they can do less. I'm always going to be like, hey, great, let's run with it. And our senior portfolio manager, Will, on our team, every week, he's pushing the business plan with the management company of achieving their numbers. They don't really need to know what our numbers are because our numbers are should be conservative. It's almost like the you know overperform, under deliver type thing. So hopefully that answers um, that question. But yeah, they never see our underwriting. Now there have been instances where, and typically we wouldn't change our underwriting, but say they came back and their payroll was at 1350, right? And but and I'm just adjusting numbers here. So their their number says 1350, but their revenue is higher. So that say their expenses are higher, or excuse me, overall expenses are higher, and their revenue is higher, but still nets my NOI. Then I'm still okay with it because they're still their numbers may not be exactly like mine, but again, as the operator, I'm heavily focused on my NOI because that's really what matters to me and my investors. All right, so going back to so we mentioned debt service coverage ratio. So if you see a 1 DSCR, that just means that they're paying the debt service. So you have to want to understand how they're paying for operating expenses and everything else. So at 1.46, this is a pretty strong DSCR, meaning I can pay I can pay all my debt service and still have, for every dollar, I have 46 cents left over for other expenses. So if you see anything 1.25 or higher and you're comfortable with the income and expense business plan, then that's pretty good. Debt yield 9.5, debt constant 7.6. This is another one as I look at break even. So what I love about multifamily is, say this is 100. How many units did I put in here? Again, I just made this 128 units. So of 128 units, if I'm 77% occupied, so of my 128 units, I need 98 units of those 128 to be occupied. So, 30 units. I could have 30 units vacant and I can still break even. Now that's not good. I wouldn't want to have 30 vacant, but this type of break even occupancy, it's good. If it's high 80s or low 90s, like that doesn't give much room for, vacancy to break even. Some of the other things you look at is deal cash on cash, cap rate. Um, cap rate varies. And typically what you want to see is a sensitivity analysis. So like in our deals, we're going to provide you a sensitivity analysis. And what that is like, I'm projecting So in this, I'm just making this. So say 5.75 exit cap rate at 1.9. Well, what happens if it's a 6.5 cap rate? Well, it goes from 14.6 IR to a 10% IR. And are you comfortable with that? There's no right or wrong answer. It's just you as an investor will determine what's best for you. But you'll want to see the sensitivity analysis. And this is what I really wanted to get across. So on the expenses, I mentioned that, you want to get comfortable. Just think of it as simple as a business. If you understand business, if you own a gas station or you're an operations, like if you understand just an income statement, if you get comfortable with the revenue and all these different line items and they make sense and there's no red flags, right? Uh, Growth is 3% or less, or maybe zero year one, or, but if it's like 8, 9%, it doesn't make sense. Some red flags, and you're okay with the expenses. Then, you go over and you're like, okay, well, I'm comfortable with the business plan. Now let's look at exit cap rate. Now, this is where I'm going to dial this back a little bit. All right. So I want y'all to look at this number here, 15.61, and this number, 5.6. If I increase this to 6% cap rate, it reduces my IRR, internal rate of return, 13.05, equity multiple 1.78, average annual returns. So it dramatically decreases. So how do we come up with our cap rate? Well, the cap rate, it's a crystal ball. Nobody knows where cap rates are going to be. They have been historically trending with the treasuries. So if as treasuries go down, cap rates go down. And that's where that sensitivity analysis comes, that where this is. But sometimes, somebody may be going like, okay, well, I think it's going to be a 5.5 cap. Well, sorry, 5.5 cap. Well, then, that drove my IR up to 16.27. Nobody knows what the exit cap rate is going to be. And if our business minded person, if you think of the cap rate as the multiplier, so you take the revenue divided by the multiplier, that's the value of the asset or the business. That's where like cap rate comes into play. So where do we get our cap rates from? We get it simply from CoStar. And so our CoStar report will show on that property, or they'll show the submarket, and they'll show like where cap rates are trading now and over the next 5 years where they're trending. And that's where we would just plug in. Because I don't feel like I'm going to be smarter than CoStar. CoStar has all those the details. Now, that's how we come up with the cap rate. There are other groups that are like, hey, we're going to do 10 basis points per year or 5 basis points per year, and they just do it that way. So there's no right or wrong, other than you want to ask, like, how are they coming up with their cap rates? Because as it showed, like it really dramatically changes the returns. Um, Other things to look at, is the financing. So think of like the debt as like the biggest investor on the deal. So they're coming in on this particular Meetup deal at 8,960,000. So 70% of the total funding is coming from the lender. Some groups, maybe they can get a 75%, maybe they can get an 80%. The higher the leverage, the higher risk it is for you as the investor, right? So there's got to be a good balance. So typically we do a 65% or 70% loan to value. In some cases, I've done 75, and on one deal I did 80. But that was the seller financing deal. It's at 80%. But typically we would be around that 70%. And why that matters is because the higher this leverage, if you look at this here, this debt service, the higher the leverage, the higher the debt service. So it went from like 600,000 to 728,000. So that 128,000 is now going to the lender, not the passive investor. So again, just understanding the debt structure and seeing, what their interest rate is how much of it's interest only. Those are good questions to ask of, if they're expecting it to be a 5-year deal and they have a 5-year loan, what happens if, year 5, it's not a good time to sell and they have to extend. The sponsor should be able to explain, how they're going to go, work through that. So All right, so I'm gonna pause there. Again, as I mentioned earlier, this spreadsheet should not be a mystery. It should be easily sent by any sponsor worth their salt. Like, there's no secret to the sauce. It's assumptions, and you as a limited partner are just trying to do your homework of what assumptions are being made and do they make sense? And do they sound like, there was thought behind it? And, if you feel comfortable with it, then you've done your homework, you've done your analyzing. And so then from once you submit the investment and moving forward, you're just trusting that the jockey on the horse is doing the work. So there's a question here. Okay, so how do you handle someone wanting to exit earlier? So this will be a great question for any sponsor that you're about to do a deal with. These, for us as CREI Partners, like if you were to invest $100,000, like that money, and I'll show you in this example here, that $100,000 went towards this total equity, and that total equity went towards the purchase of the property, acquisition fee, closing costs, working capital, capex. So that was accounted for. So, that funding is not liquid. So, I would not invest anything that you think you need that liquidity back in that 5 years. If there's a one-off instance where, there's extreme circumstances and we're able to find, or you're able to find an investor who will come in and take your position, that's something that the sponsor may be open to, but, these are not liquid investments until they sell. That's a great question. You may find though, like as you're, talking to other sponsors and all, they may allow it, and they may be like, yeah, it's fine as long as you find somebody to backfill it. We just, we have not done that. So, all right.
Looks
So
like he had one follow-up question too.
if it's a 5-year deal and if you have to extend, but the investor is not, yeah, it's another. So this is where reading the subscription agreement and so there's 3 documents. I'll show you this. So for those that are newer, so private placement memorandum. So this is like if you're about to buy your timeshare, and there's all these documents about the risk and, business plan. All this is going to be outlined. The team, returns, it's all going to be there, but you're not signing the PPM, right? That is, that's an informational document. Most of it is to scare you out of the investment. That's its purpose, the PPM. But there are 2 documents you are signing. You're signing the subscription agreement, and you're signing the company agreement. When you invest in a deal, you are becoming an owner in the entity. So say 1334 Rockdale LLC, and you've invested in a deal on a property. You're an investor in this deal, so you're an owner in this entity. You're not able to get your funds back until this company, think about like you're buying a business, until that company dissolves, which means sells. So these 2 documents, subscription agreement, if you put in 100,000, this is going to be about your shares agreed upon. So for, say you do 100, so for us it's $5,000 per share. So you do 100,000, so it's what, 20 shares. That's what you're signing there. But this, what you just asked, and it's a great question, that's going to be found in your company agreement. Also capital calls and other, things that relate to that business is going to be in this company agreement. So very important document. This is the document you are signing, and this is the document you really want to read closely. So hopefully, and every deal is going to be a little different. Every sponsor is going to be different. So as long as you're comfortable with the subscription agreement and the company agreement, you'll be good to go. Typically, they're not going to change the company. Like I wouldn't change the company agreement or a subscription agreement for an investor. If it doesn't work for them, it's okay. There's other deals, there's other sponsors, other properties. So you may not be able to change anything in subscription agreement, but definitely want to read and just feel like you're comfortable with it. So another thing on this 5-year deal, it's because it's a great question. If a deal isn't, say the market just it doesn't make sense to sell, like today, like I wouldn't sell any of my assets today. Does not make sense. The people that are selling today are people that cannot refinance because the interest rates are higher, and they can't sell because because the interest rates are higher, the value of the property, it doesn't make sense to sell. So the cap rates are high. So why would I sell a deal if I can extend another year or two and be in a better position to sell at a higher price to get you a better return, or better yet, make sure I can at least provide the initial investment. So that's where you just want to have those conversations with the sponsor. For us, like we have Shelby on the team, and I'm here. So if there's any questions throughout, we do monthly updates. We provide monthly financials. We do quarterly distributions. We haven't missed any of our distributions that were budgeted or planned. And so those are things that we take pride on. So, but you're going to want to talk to us or a sponsor about how they plan on handling the deal. So if there's anything you take out of today, just know like there is a behind the scenes of your PowerPoint presentation that you're seeing. There is an Excel spreadsheet or some type of modeling that's happening, and asking for that model just to see what the inputs are, I think is good to do. I think asking questions is a good thing to do. There's several on this call that have invested with us, and that I took time and we went through questions, we went through underwriting. I put you in touch with other investors who have invested with us, like referrals. Like they should be open to sharing other people who have invested in the deals. And so as you're looking at the underwriting, seeing about other referrals and just how the communication style with that sponsor is just going to make you feel comfortable investing in the deal. So any questions? I'm happy to go further into anything. I know it's getting a little late. All right. Well, what I'm going to do is I'm going to stop sharing and then wait a few more minutes to see if there's any other questions that come along. Um, Again, to summarize though, please do not overcomplicate real estate investing. Think of it as a business. Revenue minus expenses is profit, net operating income. Understanding the business plan, understanding like where they're coming in on the revenue, where they're coming in on expenses, where their capital dollars are being spent. Those are good questions. And if they're being transparent and going through the business plan, and you're trusting the team and they've got experience, then I think, look, I'm on a 9-month RV trip with a family because of how real estate has blessed our family. So, and I've got other investors who have retired and are just living off the income that, we're producing for them and seeing the tax benefits year over year. So hopefully, that will continue to go for you and other investors. Great question. Yeah, I got a question here. What's the minimum acceptable DSCR? I would say 1.25. And 1.25 is what Fannie and Freddie, the agencies, determine as typically the minimum. Sometimes they go as high lately as like 1.35. So there could be, between 1.25, 1.35. Those are definitely very good, strong DSCRs. Anything above that, it's even better. But this DSCR only matters if the income and the expenses make sense, because I can make this DSCR look incredible. Like if I can double rubs, now my let's see, what did I do there? So 1,700,000. Did it update anything? No, it didn't. So yeah. So my DSCR is 1.53. So again, it just really depends on the inputs and being comfortable with what they're underwriting. All right. Can we use 1030 exchange on these deals? So the answer is yes. For us, our typical 1031 is a million. We did most one recently for 600,000, but typically it's 1 million. But there are definitely groups out there that do it. We have an actual deal we're closing on very soon. That if you do have a 1031 and want to talk about it, yeah, it's a great way to have those benefits, but then also have the ownership, and then have a percentage of the cash flow and the depreciation. Good question. But one question that isn't asked, that I'll mention. So like on 1031 exchanges, sometimes people ask, well, if we do an investment, can we 1031 that, when we sell the property, can you 1031 that into another syndication? And the answer is no, unless all the limited partners on that, remember going back to that company. So, where did I put it? So if 1334 Rockdale LLC, if all the investors decided to do a 1031, then yes. But if some people are like no, and for us, we would sell, so that wouldn't be an option. If they, you know, if some investors like no, then you couldn't do it because you would need all of them to agree. All right. So with that, I'm going to stop share. I'm trying to see how I stop recording.